Hi, everyone. I'm Rick Benson. Today is Tuesday, August 2nd, and welcome to this week's In the Know Trader Show. We've got an interesting show for you today. We're going to talk about using your own intuition with your technical indicator settings. And then in our sector focus, this week, we're going to take a look at the Dow Transports and the 10 biggest names in that very important sector. So we'll take a look at the chart of the IYT, which is the ETF that is the Dow Jones Transports. We'll also take a look at it in relative terms to the S&P. And then we'll take a look at the top 10 holdings in the Dow Transports. First, to sign up for my weekly ETF Tactical Trader Report, generally comes out Thursday evenings. This report is designed to give you a very good backdrop to the entire macro scene. We look at rates, the dollar, commodities, and a deep dive into the S&P and what I expect from each of those four different asset classes. I then give you a new ETF trade idea each week and walk you through every open trade we have until it's closed out each week. So we update targets, stops. If things are working our way, we'll tighten up stops, when to get out, partial entries and exits, etc. Walk you through the entire trade from start to finish. That comes out Thursdays. You can also sign up for the monthly 7-Eleven report. We had a new issue that just came out 2 days ago to start the month of August. And this report is designed to beat the S&P's return over time. And I've got some results to update since last time. So through July 31st, just a couple days ago, we are outperforming the S&P by 2.6%. This year. That's a little more than halfway into the year, so we could easily target over a 4% beat this year. We've outperformed 6 of the 7 months this year. And even more importantly, the 7-Eleven report has outperformed the S&P by 7.16%, also known as 716 basis points in the 24-month history that we just concluded. So we started this report in August 2020. We just finished July 31st, 2 years. If you followed our recommendations, you have outperformed the S&P by over 7% in the 2 years. If that doesn't sound like much, then you may be misinformed on what money management is like, because historically 6 out of every 7 people who play this game cannot beat the benchmark over time. By the fact that we have in the last 2 years puts us in the top 10%, the top decile of all active money managers who are benchmarked to the S&P. Now, as it currently stands, we are not actually managing money. I am looking to do that in the near future. But as of now, by following the 7-Eleven report that comes out, it's in your hands before the first of each month to reallocate what you need to which one of the 7 out of the 11 sectors we're going to be in for any given month. You have well outperformed the market. So if you're in spiders, in your own portfolio, if you're a money manager for others, in other words, like a financial advisor, and you have clients in spiders, I highly recommend you take a look at this report and look at the value it brings. For less than $100 a month, you get to, over time, outperform. So this way more than pays for itself quickly, and shows you that with a methodical approach to the market and good money management technique, you can outperform. And accepting the benchmark return as good enough does not necessarily need to be good enough at all. And we've proved this to you. So those are the statistics. I've also, as you know, and you're probably watching through it, I've started my own In the Know Trader YouTube channel in order to sign up for it, to follow it. And the advantage of following the channel is that you'll get a notification every time I put up a new video. Now, I'm going to try to stay on the same schedule of posting the videos on Tuesdays as I had done them when I was doing my videos for stock charts, but I am no longer doing them for stock charts. This is how you can get the information, is following my YouTube channel. And by the way, I just tell you this last character here, this is the short way to sign up. Just go to this site, and that is a 0 at the end. That's not the letter O. You will then follow or be able to click on follow, and therefore, again, you'll get notification. And my Twitter account is @InTheKnowTrader. So occasionally I will tweet under this mnemonic of In the Know Trader. So follow me there too. All right, before we get into the depth of this week's talk, let's start off by taking a look at the S&P macroeconomic ETF performance, but this is now second half only. In other words, from July 1st until, I guess, August 1st, because today's August 2nd, so this includes through last night's close. And the reason we're looking at it just in the second half as compared to the whole year to date is because things have shifted in the second half. And I want you to just pay attention to the fact that the S&P is up almost 9% since the close of June 30th. Take a look, consumer discretionary, the worst sector of the year in the first half, is now the best sector so far since the second half started. Technology and industrials are the only three, along with consumer discretionary, that are beating the S&P. Notice as you make your way across to some of these other sectors, healthcare, one of the shining stars of the first half, is actually the worst performer since June 30th. Energy, which was and still is the best performer year to date, is not even doing as well as the S&P since. So we've seen a rotation. Obviously, you've seen the market come back, and you've seen a rotation into what was beaten up this year is now doing better. So tech outperforming, consumer discretionary outperforming, industrials outperforming, and some of the defensive parts, staples, healthcare, utilities, REITs, all trailing, REITs not by much, but all trailing, with healthcare the worst. So it's important that you pay attention to this, because not only is it last month was the beginning of the second half, but it's also a new quarter. And often that is when institutions will shift their macroeconomic sector ideas. So they're not flipping. A company that manages significant amount of money is generally not in and out of sectors with frequency. They try to play them as longer term themes. So we had a theme in the first half of the year, and at least what this shows us is, to start the second half a month ago, there's a decidedly different theme, and that's fairly in line with, when the market bottomed and the subsequent bottom that was made since the middle of June, when the market made its lows for this year. So you are seeing a shift here, and it's important as an individual investor that you pay attention to this, and that's why I'm showing it to you. Let's talk about the idea of using your intuition with technical indicator settings. So I say that because there's a lazy way of approaching the markets, and that's just simply accepting whatever default setting is used by whichever charting system you're using to access your charts. So for instance, let's take a look at this chart of the IYT, the Dow Jones Transportation Index, as an ETF. And I've got the weekly bar chart here, and beneath I have a MACD indicator, and beneath that I have an RSI indicator. And this RSI indicator right now is at the standard default period of 14. That the person who designed this model in the 1970s, his name was Wells Wilder, and he created this particular indicator to show you overbought or oversold on a scale between 0 and 100. And generally people will use 70 or 75 as if the indicator gets that high as being a sign that things are overbought in whatever security you're looking at. And if it gets down to 30, or some people use 25, it's oversold. And they'll look at the movement back and forth between those levels as signs of when you can potentially sell in an overbought or buy in an oversold. Now, I've done videos in the past on how to best incorporate an oscillator like RSI into your toolbox of technical indicators. But what I specifically want to focus on today is the actual setting. And if I go into looking at the setting, by default, this charting system and most will choose 14 periods as the default setting. So if you just click on your RSI, whether it's a daily chart or a weekly chart, monthly chart, doesn't matter, you're most likely your charting system is going to use 14 periods. And here's what I have to say about that. The lazy approach to doing your analysis is to simply click on RSI and take the 14 period. But my question to you is, why would you look at 14 periods? And there's certainly nothing that I have ever come across with the rationale behind why Wells Wilder picked 14 periods. 14 days is different when we think 14 days, oh, it's 2 weeks. Well, but 14 days includes weekends and the market's not open on weekends. So a 14-day RSI on a daily chart is actually 1 day shy of 3 weeks of trading. Intuitively, that's not a number that means anything to me. 14 weeks is close to 13 weeks, which is a quarter of the year, but 14 weeks is like 2 3/4 months. Again, doesn't make sense. So you could just look at the RSI as it defaults, or you could be a little more intuitive in thinking that I at least want to reference an amount of time that makes sense. So when I look at a weekly chart like we're doing, I think about, all right, well, 13 weeks is at least a running quarter. So if I'm going to look back 13 weeks, I at least have some semblance of a rational reason to pick a time frame. And if I change it, notice that right now the RSI with the 14 is at 48.3. It's not going to move a lot by moving it to 13 weeks. When I hit apply, it didn't move some things. Let's go through this again. 13. So let's see what was 14. If that's not moving, then it's very strange that it's not, because there's no way it's the same. So I'm going to take off RSI and put it back on. And there we go. When I turn this to a 13, it moves from 48 to 50. Again, not a big change, but in my head, if I'm looking at a weekly chart, a 13-bar period makes sense to me. A 14-bar period makes no sense to me. If I'm looking at a daily chart, I'm not going to look at 13 days because that was my weekly chart, and 13 days doesn't really represent anything that makes sense. So when I look at a daily chart, I usually am going to have it default to 11 days. Why 11 days? Because that's a half a month worth of trading in your average month. there are 20, if you take that the average month has 30 days and that there are 4 weekends of 2 days in the weekend, you take away 8 days, that gets you approximately, well, it gets you exactly 22 days, and most months have 22 days. Some have 21 if we have trading days. Some have 21 if there's a holiday in there. And of course, some get the extra day when you have 31 days in the month. So 22 days makes sense to me as the average amount of days of trading in a month. And if I'm looking at a daily chart, I kind of want a short-term picture. So 11 days is at least half a month. So I look and I change my default for a daily chart to be 11 days, not 13 that I use for a weekly, and not 14 that anybody is going to use as the default simply because that's what your machine tells you. If it doesn't make sense, then I don't use what a machine tells me. That's the difference between bringing in some intuition into what you do or taking the lazy approach to things. If I do the same, for instance, with the MACD indicator, the MACD indicator by default uses 9 and 26 bars. You have a 12-day moving average, a 26-day moving average as the two exponential moving averages that are used, and it crosses with a 9. And the reason that I don't fidget these is simply because 9 and 26 happen to be the same 2 key levels that cloud charts use. And cloud charts were invented well before, I think it's Gerald Appel created the MACD indicator. Cloud charts go back to the 1940s. MACD, I think, is from the 1970s also. Now, Appel has never said that he came up with 9 and 26 because they were part of cloud charts, but I keep them that way simply because they match up the conversion line and the baselines on a cloud chart. If I wanted to get really cute, I could change the 12 to, again, a 13 on a weekly and maybe an 11 on a daily. But in this case, the default is 12. It's not 14 like RSI. So it's only one little tick away either way. So I wouldn't expect a significant change. So some indicators I changed, like RSI and MACD, is one I don't. But the point of this is that I want you to at least think about why you're using what you're using. And just because it's in a textbook doesn't mean it's right and doesn't mean it serves you best. So think about that as you go through your indicators, if there's anything that makes more sense than what the default settings are. Okay, let's now take a look at, we're on the IYT chart. So I'm going to leave this on because this is what we want to start off by analyzing. And what we see, well, I'm going to switch this to a weekly chart because weekly charts are what I use for kind of medium term. Tactical trading, not necessarily so, but for getting like the bigger picture of what's going on, I do care. So let's look at a few key things that we can look at from this chart. First off, let's look at where some resistance might come. So I'm going to look at where some important lows came in the last year. And you can see that essentially this had been in a pretty decent trading range between the horizontal purple lines that then broke down in April and May of this year. And the breakdown also came because we broke the cloud chart, right? So price action broke beneath the cloud, the first real warning system that things were potentially changing. The lagging line, this blue line coming through the bottom here, didn't happen until close to what ultimately became the bottom. But at least you knew at this point, you're probably not looking to buy. That's at least the minimum takeaway you get, is that you're breaking down from what had been a year-long trading range. Your cloud breaks, you're beneath those lows. You didn't want to You don't want to be a buyer until you have a reason to subsequently be a buyer. Now, the combo model got to a 13 on its all-time high, which is often, again, it's why we use this model. It's part of Tom DeMark's suite of models, and this one looks for a particular count, and when you get to the 13th bar, often suggests exhaustion of trend in real time as it's happening. As there's no better model out there that in real time can get you the exhaustion point to a trend than this model. And I tell you that with over 40 years of experience on Wall Street and 27 years that I've been using DeMark's models. There is no better model out there that can more pinpoint a potential endpoint to a trend in real time. Any moving average model is never going to get it at the exact high or low. It's always going to be a lagging indicator. This is the only one I know of that can actually nail potential turns as they're happening. On the way down, we got to a 12 towards a 13. So this missed by just one price bar of certain relationship of getting that 13 to have picked the low. At the very least, when you're on a 12, you know you don't want to be a seller anymore because you're potentially simply one price bar away from getting the exhaustion point. So I can't tell you that I picked the low in transports, but I can tell you I certainly wasn't selling down there. Now we know that we've got resistance back up above kind of the 245 level, right in 245 to, let's call it 247 is where we're going to find resistance now. And you've got to really get through 247 to open the door to get towards 261 or so. Those are the two critical levels. On the downside, if transports, as long as they hold above about 216 on any pullback we see, then they're still potentially you've potentially seen the bottom, and that's the level that you really need to hold. Anywhere from, I'll call it 221 to 215 and a half is what you need to hold now on a pullback to think that we can still do some type of test of where we broke down from. Let's move now to transports versus the S&P, so relative performance. And you can see we're going back a few years here. This was the COVID low on the far left. This was the high in spring of 2021. And some of these downside exhaustion signals having shown up, haven't really gotten any bit higher than there. But what we can see is that we are getting closer to the apex of this triangle, such that if this breaks out to the upside, it may very well be the real deal. And if we break down here, that would be problematic. So pay attention to this in the relative positioning of going into transport names. And I'll take a look at these 10 names in just a minute, but realize that since August of last year, so an entire year, even though this has had some moves, we're basically in the same neighborhood we were a year ago. So you haven't had any real advantage as an investor being in transportation names in the last 12 months. You're pretty much in line with what the market has done, and which in this case is, we saw a good second half to last year, and we've seen a lousy first half to this year. So you're kind of in the same place. Now, let's take a look at, let me go back to where do we have the IYT chart? And now let's go through those names. So we're going to do these in market cap order. Here's UPS, the strongest weighting in the Dow Jones Transportation Index. Notice there is somewhat of, in fact, I'll even change this over to being a channel that we've been trading in recently. So this has been in a perfect kind of channel since we've made the highs. Notice that price is bumping up against the bottom of its cloud. At the same time, the lagging line is bumping up against the top of its cloud. That is some resistance. So if you're looking to sell into the rally, even potentially as a short-term trade, this is an idea that you may lean against just to put on a tactical trade. Now, The tactical trade may not get much because the sell-off may only go where the lagging line and then comes and holds the bottom of its cloud at 187. So it's trading 194 right now. It's 7 points on something that's in round numbers near 200. It's only about a 3.5% trade idea. So it may not be worth doing, but understand that there is resistance right about where we are now. You need to get multiple Friday closes above 203.25 to then potentially go and test all-time highs. Otherwise, you're going to have resistance anywhere from here, really up to 210 for the next few months. Okay, next, UNP, Union Pacific. Here's a railroad. All right. Also got to a 10. Let me look at sequential. I doubt it got, didn't get the 13 either. Running into some resistance at the bottom of the cloud, the lagging line's up against its baseline, same type thing. It could be a little pullback down to 215 from 222. It could be a little more substantial down to 212-ish, or we could actually come all the way down, essentially testing the lows and get down to 201. So at least you know your parameters in here. MACD is trying to cross. Let's look at the CSX, another railroad. Bottomed right. So 1 week after the 9, we went extend a little low. We hit the full propulsion exhaustion level. Notice by the time we closed on the week that made the low this year, the lagging line held within its cloud. We've already come out through the top end, but you're going to find some resistance here against the kind of narrow cloud, which is, let's call it 33-ish to 35 or so. Tough call here on what to do. I'd potentially sell a little strength. You certainly don't want to be short against new highs. So I'd probably, I'd risk, if I was going to put this on as a trading short, look to sell a little higher and stop yourself out no more than $2 above that. Let's shift to airlines. Southwest, ticker LUV, has multiple lows. In fact, I'm going to take the cloud away for a second because it's just easier to see that if we look at last December's lows, let me draw a horizontal line here. You broke beneath them and tested the stop out level from these 13s that showed up in November and December. While you're testing them, you created another 9. This is known as a 9-13-9 pattern. That's typically a bullish pattern. I would say that you need to get, well, you've got to get above kind of 40, where is that, 45.80 to really get a proper breakout to this. So in here, not enough for me to really go and chase after this the way this is trading. FDX, Federal Express. Same kind of channel that we're seeing. We certainly can connect lows in here. It's not quite as good on the upside. Friday closes over 243.25 is your first sign that things have really improved. Getting over 250.5 or so is better. Then you could potentially target all the way up to 308. In the meantime, though, this is still building a base. I don't think the cloud's going to do us much good here. Well, actually, it will. It tells us where it confirms some resistance right around 250.5. So that's a place to lean against with maybe trading stop above 268. What do we have next? ODFL, Old Dominion Freight. One of the better looking charts, well up into its cloud. Look for resistance up here against 325. And this never completed a down count, so this could still be in a trading range. Like other ones, we've seen some MACD crossovers. It is showing some strength here, but I don't have enough proof to say that this is coming back to make all-time highs. Back to a railroad, Norfolk Southern. Has stopped at its baseline on the rally. As long as this pulls back and goes no worse than 235-ish, 233-ish, it's okay. So we could still kind of pull back here and still get a lift. Your downtrend line from all-time highs isn't until above the cloud, so you could look to potentially lean into the rally somewhere in here, 270-ish, and stop yourselves out either above the top of the cloud or above the trend line, depending on how you want to play. You can see that I'm still willing to sell into rallies here. Uber. So Uber has a good, strong week after 13.9 bottoms here. So this is a good move. I would expect this to carry up to 31 to 32 and a half. That's where you have your decision making really of significance. But you've got a good bottom here. Shorts are being punished. Uber, I think, just announced too. I think that's part of the big strength. Probably was today, in fact, I'm guessing, just by the fact that this is up $4, which in percentage terms is significant. So I would look for this to extend higher at this point. I love we did. So let's do Delta. Delta also has the 13 and 9s on the bottom. Again, once you saw this right against your propulsion exhaustion level, which was virtually the same level back down from February, all the selling got absorbed and we're starting to move higher. So there is some up room here. Only 3% higher is the conversion line, but my guess is this could probably extend to 36 to even 38 and a half or so. So I do like Delta. And last one is Expeditors, EXPD. 913 kind of indicating downside exhaustion, never really progressed past that, but you've got a solid wall above you near 115 or so of resistance. And you've stalled 2 weeks in a row against the baseline. There's not much here, not one of the better names. Shows a MACD cross, but even our size pulled back this week. Other names better in the group, and it looks like Delta and Uber were some of the better ones we've looked at. That's it for this week. Hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader. We'll catch you next week.